in the wealth accumulation process, you are obviously going to look at the tax no-brainers or pensions and ISAs, maybe even VCT and EIS first. You will then look at the power of collective investments generally to give you wide investment choice and potentially generate tax-free dividends from an equity collective investment up to £2,000 a year and tax-free capital gains of over £12,000 a year. But what beyond that? Then how about considering an investment bond, UK or offshore? Why would you do that? They're not really the thing anymore. And they aren't really the thing in the sector. They seem to have slipped off many people's radar. Understandably, back in 2008, when we had those big changes to CGT rates, and they fell to half the income tax rate, when they were decoupled from income tax in the way that they were, i.e. they were previously gains were taxed as income, and then they got their own tax rate, and it ends up being half that of income tax. So inevitably you think, well, why would I go for not a collective investment bond, a collective investment with those rates? And then of course the general advent of platforms has meant it's been just generally easier to do unwrapped investments. But the investment bonds, UK and international, do have some long-standing, and I would take great reassurance from that, long-standing tax deferment potential. It's been with us for a long, long while, and then the ability to withdraw funds tax efficiently. A quick reminder, I think, is due on the taxation internally of the money that's managed for you by the life insurance company, be they UK or international. Okay, UK investment bonds first. You get a kind of protective wrapper when you invest in an investment bond. There is no tax on you until you, or even potential for tax on you until you take money out of the bond. So during its running period, during the time the life insurance company are looking after the money for you, there is no tax on you. There is tax on them. But let's think about the flows. Dividend income. What tax does the life company pay on your behalf on the dividends? A big fat zero. No tax, no limit on that tax freedom on dividends. How about interest and other income? Okay, the rate is 20%. That's the UK life company rate, which is importantly anchored to the basic rate of tax. It isn't corporation tax. It has its own linkage to basic rate of tax. So when we see the increase of corporation tax to 25% for profits over 250,000 in 2023, that will not apply to UK life company taxation because the rate, said once again, is anchored to the basic rate of tax. That's why it's 20% now, not 19%, the current corporation tax rate. How about capital gains? Gets a little more complex. Broadly speaking, the life company doesn't pay capital gains tax. It does pay corporation tax on its realised and deemed capital gains. And that tax on the deemed capital gains is then spread forward over 7 years. So there's often, it's not very much when interest rates are quite low, but there's often a discount in the rate of tax that the life company takes into account in either pricing the unit or deducting money from your cash fund or selling down units to pay the CGT or the reserve for, it's not CGT, to pay the corporation tax on the capital gains. This is explained in a lot more detail in Techlink, but the upshot of all of that is dividends, zero tax, interest and other income, 20%. Tax on capital gains, actual and realised, a rate not greater than 20%, but quite often less than 20%. Meld that lot together and you end up with an overall rate of somewhat less than 20%. But key point here, you get a 20% tax credit when you take money out of the fund if a chargeable event arises. Okay, international bonds, how are they taxed? A lot easier to understand here. There is no tax on the underlying funds of international life bonds. Dividends, interest, rent, capital growth, all subject to no tax. That's why they look so appealing on an ongoing basis, because there is no tax at fund level. I'll leave aside any discussion of charges. However, it's also absolutely important to take into account the tax when you take money out of bonds. If you're comparing, should it be UK bond, should it be offshore bond, then you can't ignore the tax liabilities, potential tax liabilities of the investor when you take money out. And I'll be looking at that in another video.